We're stage agnostic, so a lot of VCs these days are stage agnostic. I think many of them started out as kind of early stage, but early stage is a little bit out of favor because capital requirements and a lack of liquidity have inhibited a lot of firms from doing very, very early. It just takes a long time to go from startup idea to a liquidity event. During the boom days, just as an aside, during the boom days, it was like 2.6 years to get liquidity. And today, the latest average from NVCA, the National Venture Capital Association, is 8.7 years. So you're investing over the long haul. Better to get a later stage company where you can make a quick return.
So speaking of returns,
that would be another major difference.
I'm sorry, speaking of returns and liquidity, what percentage of the companies that you invest in does Intel end up acquiring?
It's actually a pretty small number. Our objective for equity is to produce strategic impact, to help us sell more silicon into new geographic markets, to help us enter new markets, whether it's entering the embedded space or entering the smartphone space, both areas that we haven't done a lot in historically. So we typically don't invest to acquire. I'd say it's probably less than 1% of the deals that we do that we actually acquire.